I'd like now to turn to our fourth audio sequence, which once again is approximately 8.5 minutes long, and it will be on the topic of business models. The audio sequence will start now.
So we talked about different financing mechanisms that we have available. Many of them being in the public sector, also some being in the private sector. Public sector being taxes, different tax schemes, depreciation rules, import taxes, or subsidies that could be changed, some that are there, some that are not there yet, depending on what you want to promote. But the question is, how do we choose the different instruments? We are looking for I guess the most cost-efficient one.
Yes, of course we are. And the first thing we do, I would say, is the barrier analysis. So if certain technologies are in the market, the question often is, why are those technologies not used? Or maybe they're not in the market in that specific country or sector, and they would need to be imported. So why is that not done? Where's the barrier? And the barrier could be in different aspects. And the barrier could be in the finance sector, and the barrier could be on the side of the users or investors. What is important when we think of users and investors and barriers, we need to analyze, I would say we have a set of 3 factors we need to analyze. One is the technology as such. Then we're speaking about capital costs. I mean, maybe energy efficient technology is more expensive than the business as usual technology. This technology has a life cycle, and it has operation and maintenance costs, and most probably it has either a surplus or an earning or a saving. Meaning, for example, if we do energy efficiency investments, investing in better fridges, air conditioners, whatever, insulation of buildings, you name it, with savings in energy costs. If we build a power plant from renewable energy, then we have earnings. So all these things we can, if we look at the technology, we can compare these factors to the business as usual scenario of the business as usual technology, maybe coal-fired power plant versus solar power plant. So the second aspect we have, or second factor, is the users and investors. They have different interests, and they probably look for the most efficient and cheap solution. They might have secondary interests like, say, energy security, or maybe they're energy or environmentally conscious, but basically they wouldn't buy something or invest in something if it's substantially more expensive than the business as usual scenario. Then they need incentives to do so. And the incentive for doing it is always then a financing mechanism. And the third factor is the finance sector. Because the finance sector, usually they have certain products, and the products, they might fit the technology and the users, or they might not fit the technology and the users. And the finance sector is risk averse. So they're mostly a little bit hesitant when it comes to financing new technologies. And there might also, a financing mechanism might be constructed in a way to take away the risk or lower the risk, the perceived risk in the finance sector in order to make the whole model going. But we really need to do that barrier analysis to see where the barriers actually are. Are they with the finance sector? Are they with the technology? Or are they with the users or investors? Maybe they are in several of them, and we need to build financing mechanisms that respond to these barriers. So that was on business models. So business models and the financing barriers come together when we're looking for a fitting financial mechanism. And apart from financial mechanisms that need to respond to a certain barrier and problem analysis, we're looking for financing mechanisms that have a high leverage effect. High leverage effect means that comes to what Søren explained about the public sector and the continuation and the NAMA facility just being a bridge funding or a temporary sweetener. So is there a public sector or private sector financing mechanism overall that we're just bridging? And how much funds will they come in, either from the private sector, directly from the users, or from the private sector, or from the public sector? Might be. I mean, so this is what we're looking at. A financial mechanism comes with a certain leverage effect, and it certainly, and Søren talked about that also, it needs to come with a phase-out concept. This is key. It's not an add-on. It's right from the beginning. We know we're not aiming at project funding. We're really aiming at financing an overall, or promoting an overall sector transformation. And this is why we need a phase-out concept, and we also need an institutional setup. Why do we need that? Because we want to achieve a permanent transformation, and because we want to make the best use of limited funds, like always in the financial world.
So one thing is, now we need to identify the barrier. We have identified the barriers that needs to be addressed with a particular financing mechanism. That reflects then the investment decision by the private sector, but it should also reflect where do we get the most for our financial intervention. We should have the most for the money. So how do we choose now which instrument is the most financially efficient as from us as a regulator?
Yeah, exactly. That's what I said when I talked about the leverage effect and making the best use of NAMA facility funds, grant funds. So we can, going back to the business model, and as I said in the beginning, we have that business as usual calculation, buying an AC, which is a certain lifetime and a certain cost for operation and maintenance and so forth, and we can have the new technology and compare those, and we can compare those with certain financial instruments, and we sort of would now do some research in the market for typical investment of that kind. How much would investors expect as return on investment? And of course, if we ask them directly, they would always say, "Oh, just give us a grant. We want 35% return on investment." But this is maybe not the most efficient use of our funds. So how can we achieve that? I mean, we can do that calculation and try to get out of our funds as much as we can, and as little subsidy as we can get away with, in combining maybe direct subsidy or a concessional loan or interest subsidy, whatsoever, with a regulatory mechanism that kicks in at a certain time. So that would not cost direct funds to the NAMA facility or to the public sector, but would just steer the market in a certain direction. So it's the combination of mechanisms that we're looking at.
Okay, so David again here from the TSU in Berlin. We are back at the live stream to respond to questions. Now with regard to our fourth audio sequence on business models. Søren, you're still with us, that's very good. Please come a bit closer. By the way, we also still have a high number of participants, which is great. People do not seem to drop out. That's a very encouraging sign.
Despite the audio quality?
Yes, despite the audio quality, one would say. We did note so far only 2 questions on business models, and we will address them now. So, first of those 2 questions. What if my business model comes out with a loss?
Then you wouldn't do the business, I guess. But it depends what you want to do with it. But you could say in most cases
those investments that do not happen is in fact because they come out with a loss. Our task is now to make those investments, when the low emission investments come out without a loss, meaning with a profit somehow. So the question is now, how do we develop a financing mechanism that brings this loss into a profit instead? That can be done in different ways, and that would then be for the NAMA developer to consider which instrument would be the most efficient one in order to make that business model profitable. But there's also another option, and that's the more risky one, or the one that maybe requires a bit more courage. If it comes out with a loss, you could decide to regulate or to impose the investment, simply to impose that loss on investors that would then be required to invest in an asset which is preferable from an emissions reduction perspective. And of course that is very rarely popular, that the public sector regulator imposes an investment to a private sector and imposes at the same time a loss for the private sector. So that should be used very carefully. But in fact we accept that kind of imposing investments by the public sector every day. In other areas of activity, a simple one, maybe it's not a good comparison, but a simple one would be the imposing of seatbelts in cars. And that's, you could say, an investment by the private sector that doesn't necessarily result in a return on the investment. The return for that investment would in fact be in the health sector, where you would have a decreased cost for casualties in traffic. But you are regulating that, and that seems to be accepted as, and for good reason, as imposing a loss, you could say, or imposing a cost on the private sector.
Okay, thank you, Søren. We did receive a couple of questions which are relatively long, and I think we'll consider them for the wrap-up session later on. At this stage, maybe let's resume this Q&A session on business models with one last question, Søren. And that is, not all emission reduction technologies have earnings or savings in the long run. Where should the money come from once the NAMA facility funding is over?
I think again that's something that must be decided on a case-by-case basis. I think the important issue here is that it has to be considered from the beginning. We have seen, and we do see more frequently than we would like to actually, we see proposals for financing where the NAMA facility is taking over the first 5 years of a grant model, and then the expectation is that, or the phase-out concept as we call it in the facility, where we phase out our support and somebody else phases in, that it is assumed that another source of grant financing will be available at that time. And that is not, to us, a sustainable financing model. It has to be considered from the beginning. Where is the financing for the continuation of the activity going to come from? And that has to be designed into the model from the start. Preferably, as I mentioned with the waste treatment example, it would be good if that source of financing is in fact already participating in the beginning, and what is happening over the lifetime of the NAMA facility activity is that the weight of the different financial partners is changing, so that the NAMA facility can phase out its participation and its share is taken over by the other parties to the financing model.
Okay, thanks very much. So looking again for these explanations.